Is another round of higher blip yields headed our way? And are Treasuries still safe if we have a government shutdown this month? Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well, and welcome back to our weekly update. As many of you who've been watching Markets with Marcus this week already know, despite the Fed lowering rates by 25 basis points to between 4 and 4.25% this past Wednesday, bond yields did not go down across the entire maturity spectrum. Quite on the contrary, medium and long-term Treasury yields actually went up. I've linked these two videos from Marcus in the first pinned comment below for those of you who may be curious as to why those yields went up despite the Fed rate cut. So I don't really know who coined the phrase bonds are boring, but it certainly wasn't a lammer, and whoever it was probably didn't deal much with bonds, because it seems the next bond roller coaster is just around the corner, another possible government shutdown. This appears to have reignited a few concerns about the safety of Treasuries for some of you in our community. And for others of you here, it seems to have sparked a bit of excitement about the potential for higher blip yields on T-bills. So, with that in mind, here are the three topics that we'll be covering today. 1. Will we see the next round of blip T-bill yields? 2. Which Treasuries rose the most and which ones fell this past week? And 3. What are the predicted yields for the upcoming week's Treasury auctions? Let's dive in now, folks. Will we see the next round of blip T-bill yields? As I just mentioned, we may be headed towards one of our not-so-infrequent federal government shutdowns at midnight on September 30th, in yet another budget crisis that seems to have become an almost regular occurrence over the past few years. But how did we get here, right? Didn't the One Big Beautiful Bill Act, or OBBBA for short, increase the federal debt limit and set us up for a proper budget for the new financial year? So, as we discussed previously on our channel, the OBBBA did indeed increase the federal debt limit by $5 trillion to a new maximum threshold of about $41 trillion, which should last us for a while and is not currently an issue. And the OBBBA did make some changes to our taxes and spending rules going forward, including making President Trump's tax cuts from 2017 permanent, providing some new tax incentives for investing in the U.S., and exempting tips, meaning gratuities, and overtime from income tax under certain circumstances, among other things. However, the OBBBA is not a proper budget for the new fiscal year that starts on October 1st. And this is where the current shutdown threat starts. Without a proper budget, or at least a continuing resolution, which is essentially a temporary extension of the old budget, the government's discretionary spending will have to stop at midnight on September 30th. Now, just to be clear, all mandatory functions of the federal government, including defense and security, will continue even if we enter a shutdown. And all entitlements, payments that are written into law, so to speak, will also continue without interruption, including Social Security benefits and Medicaid, as well as all interest payments and principal repayments on U.S. Treasuries. However, non-essential government services will be shut down, including national parks, verification services for Social Security numbers, and the processing of some applications for federal grants or benefits. The government employees performing these non-essential services will be furloughed, essentially sent on an unpaid vacation, although after past shutdowns, they all were made whole for the missed wages after the government fully restarted. Government contractors will be sent home for the duration of the shutdown as well. But unlike actual government employees, contractors were not made whole for their compensation in the past. So, if we remember correctly, we haven't had a proper budget in place at the beginning of the fiscal year on October 1st since 1987. And no one really expects it this year either. However, there's still a bit of time before September 30th. Perhaps Congress can find enough common ground to pass a continuing resolution and avoid a government shutdown. We certainly would hope so, as this would send a strong signal of constructive bipartisan engagement in what are currently turbulent and often antagonistic times. We'll have to keep watching to see how this plays out. The more important question for today is this: could a looming government shutdown provide a buying opportunity for Treasury investors who have the risk appetite for it? We've discussed on this channel in the past that the run-up to a government shutdown may sometimes offer what we call blip yields, some higher than usual yields for Treasuries, and especially for those that are due to mature on or shortly after the deadline. Even though the U.S. Treasury has never defaulted on its debt payments, some investors are trying to avoid even the small residual risk, which may result in higher yields for those who are willing to buy these Treasuries. Now, these higher than usual blip yields are generally much more pronounced around possible government shutdowns that involve the debt ceiling, for the simple reason that Treasuries are more at risk from a shutdown if the government may be prevented from issuing additional debt. The good news this time, or bad news depending on how you look at it, is that any government shutdown from October 1st does not involve the debt ceiling, but only the lack of authorization for discretionary spending, as I mentioned earlier. All mandatory payments will continue without interruption, including debt service on all Treasuries for both interest payments and principal repayments. In other words, the potential government shutdown that we may be headed towards isn't really any risk to Treasury holders. So that should help some of you sleep better at night. But this also means that any blip yields, if they occur at all, may be very moderate and short-lived only, if history can be our guide. Nonetheless, for those of you who might have the risk appetite for potentially picking up some blip yields, we'll be keeping our eyes open and reporting back as appropriate. So, now that we've covered what a possible government shutdown on September 30th might mean for Treasuries, let's take a look at how Treasury yields ended the week after the Fed rate cut. Which Treasuries rose the most and which ones fell this past week? Here's our usual table with Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. And here's the increase or decrease in rates over the past week. As we touched upon briefly towards the beginning of this video, the Fed cut rates by 25 basis points this past Wednesday, bringing the Fed funds range to between 4 and 4.25%. But of course, the Fed funds rate is an overnight rate for one-day transactions only, and has its most direct effect on Treasuries with the shortest maturities. No surprise then that all Treasuries with maturities 1 year and below, all T-bills, are indeed down from a week earlier. However, the medium and longer maturities, everything above 2 year basically, are all up versus a week ago. The prices and yields in this segment of the market are less influenced by the Fed funds rate, but really determined by the market, by the forces of supply and demand. Our house view at Diamond NestEgg is that these higher yields for longer maturity Treasuries are not an immediate red flag. Markets may expect a scenario where inflation remains higher for longer, possibly in combination with a growth outlook that sees a stabilization or even a bit of a pickup. But markets clearly don't expect an immediate recession from which they would flee into the safe harbor of longer maturity Treasuries. In such a case, traders and investors would have bought long-term Treasuries and driven yields down. And it's not just this past week. A comparison with yields from September 2024, a year ago, shows that at the long end, all Treasury yields 3 year and up are still higher today than they were a year ago, when the Fed started cutting rates from its post-COVID high for the first time. So while higher inflation clearly remains a risk to long-term bond investors, we may, with a bit of luck, avoid both a recession and prolonged stagflation in the near term, and may still be able to achieve a soft landing before the economy hopefully re-accelerates. As I mentioned before, if you want a deeper dive into how the Treasury market behaved this past week, I've linked these Markets with Marcus videos in the first pinned comment below for you. Now, let's take a look at Treasury yields from this past Friday versus the beginning of the year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd of this year. And this row shows the increase or decrease in rates in 2025 so far. Yields across all maturities are down from where we started the year. The regulars on this channel know, though, that this table does not capture all the volatility that has been 2025 in the bond market, and especially not the temporary spike in yields that has occurred on multiple occasions this year. As I said at the beginning, who says bonds are boring? So congratulations to all the buy and hold investors who've either been opportunistic and picked up some of those higher yields on the secondary market, or who've been dollar cost averaging regularly into auctions. Also, keep in mind that Treasury yields at the current time are still higher than where they have averaged over the past 2 decades. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page. All sources are linked below in the first pinned comment. Keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. So, now that we know where Treasury yields ended the week, let's move on to the next section of today's video. What are the predicted yields for the upcoming week's Treasury auctions? If we go to Treasury Direct's upcoming auctions page, we can see that all the weekly T-bill auctions are happening as usual. And if we scroll down, we can see that the 2-year, 5-year, and 7-year T-notes will also be auctioned off this coming week. None of these are reopening auctions, so the coupon is still to be determined on auction day. The 2-year floating rate note is also on the auction schedule, but this time as a reopening auction. At the time of this taping on Fidelity's platform, here's where the expected yields stand for the T-bills that have been announced already. Here's the coupon and the expected yield for the 2-year T-note auction, the 5-year T-note auction, and the 7-year T-note auction. Please keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. All right, Diamond NestEgg members, super savers, and course fans, I hope you enjoyed this video and learned something new. And if you want to learn more about bond investing and building out a bond portfolio while rates continue to be attractive, then check out this video here on our bond courses. And come join our next live member Q&A to get a deeper dive into our perspective on where bond yields may be headed during these uncertain times, happening this Sunday, September 21st at 5 p.m. Eastern Time, 2 p.m. Pacific Time. I've linked all the details on our bond courses and our YouTube Super Saver membership below this video for your convenience. And see you again very soon with more brand new wealth building content for your financial journey.